Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Wednesday, and yes, she is back. The one and only Anna Kelly. Hi, Anna.
Hi, good to be back with you.
Nice to be back with you. What I want to do today is we are going to do 3 videos where we kind of paint 3 options that I believe the Fed have. And what we're going to do is I'll describe them, and then we'll talk about the economy, stocks, real estate, single family, commercial, if we want to talk about unemployment or anything else. But that's what we want to do. You ready to go?
I'm ready.
All right. So we're going to come out and we're going to pretend that Paul Volcker channels Ben Bernanke, which my experience with good old Ben was he's telling the market we're going to go slow and steady. You know, he'll do a quarter point every time, pretty much no matter what the data does. And he's, in my opinion, always going to be behind. And then he goes too far at the very end. So what this might look like is maybe 5 quarter points this year, taking us to 1 1/4. Maybe it's 4 next year, taking us to 2 1/4, maybe 2 1/2. So we don't get over 2% for 2 years. So it's kind of slow and steady. I do think that is one possibility. When I lay that out for you, what do you think kind of happens if that's the Fed's avenue?
You know, there's already a lot of people that are saying they're already too far behind the 8 ball. Like they have to come out strong. And before people said, okay, they can only come out 1/4 of a point because it'll rattle the markets. Well, now they're saying they're going to have to come out at least 1/2 a point. And I've been reading the last couple of days, you know, economists saying they need to come up with a whole point because this inflation thing is just going way too fast. And so, you know, I don't know. I'm still guessing 1/2 a point. That would be my guess, because I think if you come out at a point, it shows this is urgent, this is dire, we're losing control and we have to do this. And I don't think the government wants to put on that facade or that, you know, persona that this is bad. So I think they come up with 1/2 a point. But to your point, no pun intended, right? To your point, you know, I think that they're going to have to do multiple rate increases over the next year or 2. And initially they were kind of talking about maybe 4. Now there's many calling for 7 this year. And I don't know if they'll go quite up 2 points over the next, you know, 2 years, but I think at least 1 point to 1.5 points minimum. Mm-hmm. And then they got to kind of sit back and go, was that enough? Yeah. Did that pull back inflation enough?
Yeah, the first thing I think about, because I knew I was going to do this, so I have an unfair advantage kind of thinking about this ahead of time. First and foremost, if he does the slow and steady, you know, just call it 4 a year, it doesn't do anything to inflation. It doesn't pop the bubble. It's still out of control, and the Fed remains behind the curve. They are frankly become the laughing stock. And more importantly, all of us, the American consumers, we hurt. And oh, by the way, let's be very clear. The poor and middle class get smoked. They get really hurt if we do this slow and steady, in my opinion. Yeah. Makes sense?
I agree with you. I agree completely. And already, you know, Americans are hurt. We went yesterday and filled up our vehicle for $4 a gallon. I don't ever remember hitting $4 a gallon. I don't. And I could be wrong. There could have been, but I don't remember ever hitting $4 a gallon, you know? So the average American is being hit really hard because even the 7.5 quoted consumer price index inflation, it's much higher than that when you take everything into consideration. So I think the Fed has to be more aggressive. I just don't know how aggressive they're going to be. But it definitely, it hurts. And the other thing is, Michael, even if they raised them 1 point this year, even if they got to 2 points, it only fixes the demand side in terms of buying power. It doesn't fix the supply side. And a lot of these inflation issues are due to supply side issues and wage growth issues. So I don't know that they can fix it till they get pretty aggressive.
Well, historically speaking, the way you beat inflation is you have to get the funds rate above inflation, which I cannot imagine. Can you imagine fund rate at 8%? Where mortgage rates would be 13% or 12 or something crazy like that. That would, frankly, let me just say right now, they're not going there, but
right.
That's pretty crazy. So the other thing I think happens if he goes the slow and steady, stays behind the curve, besides the average American consumer being really hurt, is asset prices stay inflated. Wall Street keeps making money. Real estate stays up. It's kind of just like the party keeps going, which I don't think is the right answer, but I think that's the outcome if he's, pulls up Ben Bernanke. Does that make sense?
It does. I agree with you, at least in the short term. I mean, generally, because people ask, why isn't the stock market going even crazier than it already is? Because in inflationary environments, good companies' stock values actually go up. And so do asset prices, because it's a safe, businesses for a different reason, assets, because it's a safe place to park your money that's not going to be devalued. But if you go slow and steady, you don't get as much of a bump in the asset increases. You don't get as much of a bump in stock market, as you would. If they go too aggressive, my fear is that we go into deeper, faster recession, because companies cannot keep up with the additional costs. Consumers will no longer pay for the additional cost to produce those goods, and you end up hitting recession. So while I'm bullish on asset prices, I'm kind of bearish on, the economy and where we go from here, to be honest with you.
Yeah. And again, we're going to do that. We have two more examples of what the Fed do, but if we kind of close out this first one, slow and steady and staying behind, I think we probably skate by before having a recession. I don't think rates moving up enough dampens demand. Hence, right. GDP is still positive, although it's positive in a nominal term, not real term, versus adjusted for inflation, but still, a recession won't be called. The midterm election, we won't have a recession before the midterms, all of that, if it goes slow and steady. I don't think it's the right answer, but it is certainly one of the ways to go. And I think unemployment doesn't move up much in this scenario. It's kind of like the party still goes on. A little bit less alcohol, a little bit less drugs, a little bit less rock and roll, but it's still a party. And again, I think, 80% of Americans, 80% of citizens of the world are hurt, and the rich get richer, which is just, I've had enough of that. It's time for them to have some pain, I think.
Yeah. And I think, to your point, which is a really good one, is we are coming up on midterms, and that could keep the Fed from being as aggressive as maybe they should be. Because there is political fallout. Anytime a president is in office and the economy tanks under their watch, it's usually a change of guard. And so, I think even though the Fed is supposed to be an apolitical agency to some extent, let's not pretend that we aren't in an election year. And that may, to your point, keep things more slow and steady than being as aggressive as many think they should be.
Yeah, very cool. Well, Anna, do me a favor. We have two more topics to go through, but before we do that, how can they find you?
Great. You can find me on social media, LinkedIn, Facebook, Instagram, Anna Kelly, REI Mom. And you can follow my website at greaterpurposecapital.com for investing in large apartment syndications for accredited investors.
Awesome. Thank you very much, Anna.
Thank you.